What if I told you that trillions of dollars in corporate debt just appeared out of thin air overnight? Well, that's pretty much what happened when a new accounting rule called IFRS 16 came along. So today, we're going to dive into how this one single change completely reshuffled the financial world for huge industries, from airlines to retail, and what it really means for how we understand a company's health. All right, here's our game plan. First up, we're going to talk about the huge problem of invisible debt that was hiding in plain sight. Then, we'll break down how IFRS 16 swooped in to fix it. We'll also take a look at things from the landlord's point of view, which is a bit different. After that, we'll get into some of the messy, real-world complexities of leasing. And finally, we'll tie it all together to see what the real bottom-line impact is for everyone. So, before we get to the solution, let's really get our heads around the problem it was designed to solve. And it's a big one. Massive, massive liabilities that were just hiding right out in the open. Seriously, think about it. Picture a giant retail chain with thousands of stores, or an airline that leases its entire fleet of airplanes. What's their single biggest financial commitment? It's almost always the rent they've promised to pay for years and years to come. But here's the crazy part. For decades, that multi-billion-dollar obligation was practically invisible on their main financial statements. It was a promise, sure, but it wasn't officially counted as debt. Before IFRS 16, these huge rental agreements were basically treated like a monthly utility bill, just a simple expense, not a long-term debt. The enormous obligation was there, but you had to dig through the footnotes of the financial reports to even find it. Well, IFRS 16 came along and flipped the whole table. It forced companies to take that promise to pay rent for the next 10 or 20 years, and slap it right onto the balance sheet as a formal liability for the whole world to see. And that brings us to the standard itself. IFRS 16 was created for one main reason: to bring some much-needed transparency and comparability to a part of accounting that was, let's be honest, pretty murky. At its heart, the rule is actually pretty simple. The official definition says it's a contract that gives you the right to control the use of an identified asset for a period of time in exchange for payment. So, in plain English, if you've got a contract giving you control over a specific thing, like a specific floor in an office building or one particular truck, for a set amount of time and you're paying for it, bam, that's a lease. It's a really broad definition that catches just about everything. So for the tenant, the person renting, this whole thing becomes a two-step dance. First, they add something new to their books called a right-of-use asset. This basically represents the value of being able to use that building or that plane. But at the exact same time, they have to add a lease liability, and that's the big one. It's the value of all the future rent payments they've promised to make. So just like that, poof, a brand new asset and a big new debt appear on the balance sheet where there was nothing before. Okay, so that's what's happening for the tenant, but what about the other side of the deal? What about the landlord? Well, while this was a total revolution for tenants, for the landlords, the new rules were, well, less of a big deal. Yeah, for landlords, or lessors as they're called in the accounting world, things stayed remarkably similar to how they'd always been. Their main job is still to look at a lease agreement and decide which of two buckets it falls into. Is it a finance lease or is it an operating lease? And the whole decision really comes down to one key question: who really has the risks and rewards that come with owning the asset? If the lease basically transfers all of that to the tenant, it's treated like a sale with financing. That's a finance lease. The landlord actually takes the asset off their books. But if the landlord holds on to most of those risks and rewards, then it's a true rental, an operating lease, and the asset stays on their books and they just record the rent as income over time. Of course, let's be real, contracts are never as simple as just paying rent every month. They often have all these little sweeteners and incentives to get the deal done. And you better believe IFRS 16 has rules for those too. We've all seen these kinds of things. A landlord might offer a new office tenant, say, 3 months rent-free to get them to sign. Or a shopping mall owner might give a new retail store a chunk of cash to help them build out their space. These incentives are super common, but from an accounting point of view, they are not free money. The standard's logic on this is crystal clear. It basically says, hey, these incentives aren't gifts, they are an essential part of the total cost of the lease. So that rent-free period or that cash bonus has to be accounted for by spreading its value over the entire life of the lease. In effect, it just reduces the rent expense or the rental income a tiny bit in every single period. Okay, so we've been deep in the details. Let's zoom back out. Why did regulators go to all this trouble? What is the real impact on how we analyze a company? Why does this all matter? So, what does this all boil down to? First, and most importantly, we get radical transparency. That hidden debt is now out in the open. That in turn completely changes key financial metrics like debt-to-equity ratios, making many companies look a lot more leveraged than they used to. And here's a huge one. It gives us better comparability. We can finally compare apples to apples between a company that leases all its stuff and one that buys it all. And you know what? All of this might just change the fundamental business decision of whether to lease or buy in the first place. And that brings us to the final thought I want to leave you with. The next time you're looking at the financials of a company that relies heavily on leasing, think about that airline, that big retailer, that restaurant chain. Remember IFRS 16. The debt you now see on their balance sheet, it was always there. It was always a promise. But now it's visible to everyone. So how does that change your perception of their financial strength? That's a question every investor now gets to answer.